Hello and welcome to Market Makers Anniversary Special. My guest on the show today is someone who has mastered the art of analyzing, forecasting, and explaining megatrends. He's an avid reader, a great investor, and a very dear friend. Manish Chokhani. He needs no introduction whatsoever. Manish, fantastic to have you back, and thank you for joining us.
I'm amazed with that introduction, which is, I'm a student, so let's put that on record. And secondly, many congrats on your anniversary.
Thank you very much. 8 years, and with
going strong.
Yes, going strong, and I guess this is just the beginning. And thank you for all your support and all your time. In today's world, 8 years is a long time. Nobody has that kind of patience, and nobody is able to predict the kind of world we would be staring at in 8 years. Right. So let's look at what we are working with, and we are working with a very crazy kind of a market which is immune to all the bad news. Whenever there is bad news, markets are making an excuse. Whenever there is good news, markets are rewarding that news disproportionately. Everybody is saying that there's a lot of liquidity, and frankly, nobody is bothered about bad news.
I think that is the reality, and that's what we grapple with all the time. That after the 2008 crisis, the way money has been unleashed into the world and the constant printing of money, it's been a race to the bottom for every developed country in the world. And literally, I think, 13-14 trillion dollars of fresh money supply has entered the world. Sorry. Interest rates are unprecedented low. You would have expected bond markets to riot, currencies to completely go off the cliff. But who do you go off against? So what it seems to be going off against is really growth and risk assets. And therefore, you see, even in the US, for example, the top 5 companies have powered basically the entire growth of that market and are now market caps which are greater than our entire country. If you just take Google, Amazon, Apple, Facebook, Microsoft as examples of that. And people seem to be price agnostic because now these companies don't seem to need cash. So even if interest rates were to harden or currencies were to tighten, you would still have no choice but to go and shop on Amazon. You would still have no choice but to do your search on Google and so on. So it seems to be that sort of world as far as markets are concerned. So when you are faced with the fact that PE multiples are at historic highs, the flip of that also is that interest rates are at historic lows, and they really are mirror images of each other. So until I see end of the game of this low interest rate regime ending, which the bond markets don't seem to suggest because the yield curve is basically flat even in the West, and it's only the Fed which is trying to push the 30-year up. Until you see something like that going down, it's easy to say valuations are high, but I can't see how they just suddenly pop and stop. The dilemma though I have in my mind is there are 2 big powerful trends coming, which you always get at the end of a creative destructive cycle, that there's technological innovation coming at an unprecedented pace at us. And 10 years from now, I can't imagine many industries which would be still functioning the way they function today. For example, if you take healthcare, it's going to be completely disrupted. You take energy, it will be completely disrupted. You take most manufacturing, it will be completely disrupted. You take maybe finance with things like blockchain, it may be completely disrupted. So industry after industry, at the terminal value end, looks like there will be a decline in terminal values, while at the short end, interest rates are so low, it's pushing multiples up. That's really the dilemma you grapple with. And on that, you overlay the fact that all this technological change and political change basically means a lot of unhappy, angry voters who don't have jobs, who don't have incomes. Do you get universal basic income at one end? Do you get some backlash against markets at the other end? Let's see how this plays out.
You've always talked about the importance of cycles. Understand the cycle, and that's the best way to invest. Now, if I may quote you again, you've said that there is a best period, there is a boom period, there is a bubble period, and there is a bust period. So in that market cycle, where are we right now?
So honestly, post 2008-9, these cycles have got disrupted by the central banks. If you've taken away the force of gravity, which was interest rates, away from the markets, which used to be, in a boom period, you would get rates creeping up slowly, and at the top, it would make the cycle pop, then it would fall down. If you've kept rates low for so long, and the extended horizon for the next 20-30 years for all these bond markets seem to suggest rates remain low for longer, even with the hike in the Fed rate, and no one yet thinks about how does a 99:1 levered Fed get out of this mess. How does Japan ultimately repay any of its debt? These are fundamentally bankrupt countries. it should have manifested in their currencies. The currencies, each one is playing a game of, we want to beggar thy neighbor in some sense. So if the dollar falls, I will get hit, so let me also let my currency slide. And in a way, India has been, guilty of that as well. When the crisis hit, we were 40 to the dollar. We were 6 against the yuan. We are now 10 against the yuan. We are 64 or thereabouts against the dollar. We've not had, I think, an incremental 5% growth in exports. So what did we achieve? We all just decided to, become poorer and poorer and poorer, and then we worry there is no revival of investment cycle, there is no consumption. Let's get the rupee to 50 and I'll show you consumption cycle reviving. Consumption cycle revives because of purchasing power going up. Investment cycle will revive because there is now demand. So you can't keep on, depreciating your way into prosperity. At some point we'll have to change the cycle.
So if you are of the view that, look, we're staring at a new normal. Currency and interest rates, they both are artificially managed and controlled. How does one figure out what is the right price, what is the right P, how does one judge growth? Because what we've learned as students of finance and what I've gathered from you over the years, that markets, they follow a cycle. And when you stop following cycles, how does one judge the peak and the trough?
What seems to be emerging now is, in this disruptive phase, if I look back over the last 15, 20 years, and helped along a lot by this cheap money and technology coming in, these 4-5 companies have shown an example where once you become the leader in a certain industry and you form the core around which everyone aggregates, effectively your opportunity becomes global and it becomes literally unquantifiable. So if you would have looked at Amazon as a bookseller to where it has transitioned today as the global retailer of choice, the global provider of media through their Prime services, the global provider of web services to the entire supply chain, and to eventually now the home, through the Alexa AI platform. It's a company which I would not have conceived of 15 years ago that it could have made so many malls and survived all these change of orbits. Similarly, Google, from being a search leader, becomes now the Android platform. It controls all the phones and all of the world. It has all your information possible. Its next move is into medical science and into autonomous self-driving cars, and who knows what else. If you see the Google Exo video now, the amount of areas they're going into is just mind-boggling. So if these companies you were not in literally at any price, at every price it may have looked expensive, and today it still looks like a 20-25 multiple, which is not like some crazy number. And it attracts people like Mr. Buffett, who said I will never buy tech, to say I missed Amazon, or he has actually gone and bought Apple. There is something new happening out there in this world, and it is disruptive. And like I said, these 5 companies in aggregate have a market cap beyond that of India, and they weren't even around 15 years ago. So while the India opportunity is great, and we like to think that we are the toast of the world and everyone's only looking at India, the reality is everyone's looking there at what are these new companies which will shape the world. If you look across the border at China, the companies which have started controlling that market now are Tencent and Alibaba. In that sense, it's no longer the oil companies over there or the banks and all that, which are full of more NPAs than what we discuss in India. But that creative renewal has occurred in those markets as well.
Okay, so let's call the first mega trend is that we are staring at a new normal, where interest rates are different and currency is different. Now, you've always said that markets always vote for rate of change. You don't make money by buying yesterday's growth, you have to break on future growth. And big question mark is now being raised on whether Indian IT companies can really survive this storm. And it's a real storm. Old business is getting cannibalized because the new business. It's like one team which is working against me in the same company. It's that kind of a scenario. Do you think Indian companies will be able to survive this storm? Because the storm has happened in the past also, when we migrated from Y2K to enterprise and to other platforms. So is this a migration process or a structural challenge?
So there is certainly large issues, because as the technology changes in the world, a lot of the old work which you did becomes commoditized, and with the advent of machine learning and artificial intelligence, you can literally program the machine to now do the work which a lot of people were doing. It is very well said that eventually whatever is dull, whatever is dirty, and whatever is dangerous, why do you need a human being over there? You should either put a machine learning AI system there, or you should be putting a robot over there, and the world will move in that direction. But what that also means is that, like I mentioned, if industry after industry is going to go through disruption, the machine can only do what it has seen before. What it has not seen before, it cannot yet have that predictive power. it will with analytics and the way data is going. They will probably still figure that out over the next coming years. But what it means is, and just to take an example of, I'm just using Infosys as an example because I'm more familiar with the numbers there. Let's just say 60% or thereabouts of the company, or slightly less than that, is a lot of the old services which they provided. 40% of the company is actually in the new areas which are now emerging. The new areas actually are not commoditized, and you get higher margin over there and you get higher growth rates there. And when you put these two together, you get a disguised company which is showing you a sub double-digit growth rate and apparently looking like it is struggling on margins. But if you disaggregate, 2 years from now, this 40 will become 55 or 60% of the company, and the 60 will obviously become 40. And the margins are probably better over here. While at the other end, it's not dying and going away in a hurry. It's not a business you may want to give a multiple to, but the profit flow and the cash flow is still there. When you put this together, let's say 18 months from now, you start seeing a double-digit growth company, which in the global context for a company of that size with $10-12 billion of top line and with a $2 to $3 billion bottom line is a large company. From a Western market perspective, this will be a high ROE stock, high dividend paying stock with double-digit growth rate. You could get re-rated over there. In the Indian context, we have been spoiled because we saw this company as growing 50 and 100%, or we saw a 30, 40, 50 P. That's not going to return. But is this still a quality business? It is still a business which India can do well at? I would say the answer is yes. And especially like I mentioned, if you're going to disrupt healthcare, you're going to disrupt auto, you're going to disrupt manufacturing, you're going to disrupt finance, who is going to do all this work for you? It cannot all be only these 5 great US corporations. They need these what I call pick and shovel workers to do some of it as well. And like I pointed out in the case of Amazon, companies also morph. Yeah. If I take my own business, if 10 years ago you would have said brokerage rates are going to crash and brokerages will all now die, see what has happened to the brokerages. Ours of course is not listed, and of course it's done very well within Axis. But you take Motilal or you take India Infoline as the listed peers, see how the businesses have transformed and actually become larger. The profits are at all-time high compared to where we were even 10 years ago when people thought there's gloom and doom for this business.
Let's move to the other mega trend, and that's 10 years ago the logic given by investors like you was that avoid PSU banks because private guys are gaining market share. Sure. But now for private banks there is a competition, and that competition is fintech, yes, cryptocurrency, sure, branches will get digital, sure, and the whole experience of banking will change. Yes. So what happened to PSU banks? Could that happen to private banks now?
So interesting you say it, because this is all productivity tools today. So first, to put in context, the PSU bank 70% type market share, I think incrementally is already approaching less than 45-50.
And nobody wants to bank with them.
They're already losing share. No, they're getting large share of deposits, but they are recycling to pay off the old problems. The challenge for the government is how will you ultimately protect these depositors if everything is going to go to service those old NPAs. So there has to be, and there is enough work going on there, and it's not the topic to discuss today, of how this sector has to change from being 70-30 in favor of public to being 70-30 in favor of private. So the opportunity set for Indian banking is still unprecedented. If you take now what is happening with GST and the whole move to the whole country becoming more and more organized, everyone has to come into the banking net much more. Maybe we go from a 60% organized, 40% unorganized, or let's use bank to unbanked. The ratio has to go up. So if you take a 2 trillion economy, of which half was probably dealing in cash in some form, if more and more of it comes into the real economy, then the 2 trillion itself is growing. Of that 2 trillion, the money which was going into financial savings was a subset, because a lot of it went into cash and gold, and that was the unaccounted money. If that starts shifting more and more into financial assets, and within that you have this 3, 4, 5 well-run banks who all know what they're up to, and they're going from the top level of private banking to complete microfinance level, the entire chain, and you're now getting the tailwind of technology coming in. Treat it like when ATM came, you would have thought, what will I go to a bank branch for? I don't need the teller. The ATM actually extended the reach of the banks. Same way, if they are able to use, say, blockchain to verify and trust SME, which was a large area which you could not lend into, or you use a lot of the fintech for providing better payments, you actually harness this technology. And what happened, for example, in telecom, that we literally leapfrog from fixed line to 4G ahead of the rest of the world. It's possible it happens like that in Indian banking because these are still young banks. I mean, the leader, our largest bank in India, is HDFC Bank by market cap.
Yeah.
It's what, about 20, 25 years old? It's a young bank.
It's a young bank.
It can still completely change and morph, and they are still at the forefront of what they are doing in fintech. It's not like a new fintech startup in India will come. I will have so much trust that I will start deploying deposits and all with them. I will shift my whole banking over there. They can do my cash management also. They can do my working capital also. It's not happening at that pace. So I would bet on, like the internet made financial services a big winner. I think the advent of cloud and fintech combined provides an even larger opportunity to Indian financial services sector. And it's not now restricted only to banks. You can play through, they are very good, well-run NBFCs. There will be listed asset management companies which will come out. There will be large insurance companies which will come out. So the power of all this tech coming into financial services in a way exponentially expands our brains. I'll give you a small example. Like earlier when we used to research companies, I had to sit and draw up the balance sheets, calculate the ratios and everything. If I had to run a screen on companies to see what meets my criteria, what is turning around, it was a tedious job. Now it happens in a tick of a second. I think you guys on the channel can now probably do it faster than what we as investors do. That has exponentially increased my ability to make investment decisions, made the scope of my business larger, and allowed me to now expand my scope. From being an individual investor, we went into, for example, brokerage, investment banking, asset management, NBFC, and so on. The whole scope expands dramatically. So for well-run financial services companies, banks, I think golden days ahead.
But we cannot extend that same logic when it comes to manufacturing. You know, Jeff Emmelt, he was on in ET Now forum, and he said, look, manufacturing is going to change, and we at GE are not for it, but we think that Internet of Manufacturing is the next big thing.
That's right.
There is surplus manufacturing capacity in the world.
That's
we
right.
are staring at something called 3D printing. What will happen to manufacturing in the world?
So you should worry about China, not about India. We don't seem to have any manufacturing to speak of to start with.
Yes.
So let's not worry so much. But the reality is, yes, that if you have built these large metal bashing companies, which then are what you call subtractive manufacturing, take a piece of metal and then break and come down to one piece of forged material or whatever. If you can now do this through a 3D printer and create the most intricate complex patterns, and there's no cost of variety, there's no cost of complexity, clearly that's the direction the world will go in. If you can do then therefore customization at a mass scale, like my printer today, whether I print a spreadsheet or a PowerPoint or an Excel, it doesn't care. It doesn't care how complex the spreadsheet is inside. For it, it's just another thing that is printing out. The same thing as a 3D printer. If it can today print plastic or metal more conveniently than a lot of other materials, that time will also come, and the cost of this is crashing. In theory, tomorrow you could now print your own shirt and your jeans, and it could be an exact fit tailored to your requirement. But it's 7-8 years away. It's falling at a dramatic rate, but it's some time away. It's a bit like we are discussing 3G in a fixed line era.
Okay.
It's coming at a very rapid rate, and a lot of the investment cycle people holding back today are wise enough to think that if I want to play, my asset is going to last for 10 or 15 years. I cannot be now buying a machine which is going to be obsolete in 5 or 7 years. So from that context, it's a very powerful thing coming. If you combine 3D printing with, like you said, Internet of Things, and you can make literally every bulb or every object a smart thing by just embedding a sensor in it and thereby controlling it, which is really the direction GE has been taking, you revolutionize manufacturing as well.
Inventory levels change.
So again, the dumb players in this business lose. The good players in this business already have the customer. If they are able to play this game well, they can stay ahead of the game, or like with every other thing, they get disrupted as well. So it is coming. The scarier things which are happening in disruption ahead of 3D printing and all, in my view, is energy. I think the era of oil clearly is gone.
The dirty fuel time is over.
I mean, if Saudi Aramco says we have to IPO the company, they realize the game is up. I think if you have to go out in the world and IPO a coal company or get financing for a coal company, it's not happening. The world clearly is going towards solar and maybe gas. In the next 10 years, if not earlier, I would be surprised if all of us were not driving an electric vehicle. I would be surprised if, leaving out Bombay, the rest of India did not have a solar panel on their roof and brought down their cost of electricity dramatically. I would be surprised if businesses which we thought are energy intensive and avoid them would not become the new darlings because cost of energy is literally free. I would be surprised if the Indian currency, which kept getting a bashing because we kept looking at oil prices, doesn't dramatically change because you no longer have energy imports and you become an energy surplus country. What happens to our manufacturing, what happens to our consumption, what happens to our currency, our purchasing power? You can have a sea change in that. And in that scenario, I would worry about banks which are lending 10-year. Like you worry about steel or power today and maybe telecom. I suspect the next leg of worry will be in in this space.
So technology is going to be obsolete, and
so energy is changed totally. I have no doubt in my mind about it. The number 2 change I can see is in medicine and healthcare, with the way they have cracked the genome and the way costs are declining of computing, and you now digitize the human body, and you can literally read the human body as a ATCG code as opposed to a 10 on a
all
computer.
Science fiction stuff, right?
It's not. It's happening in reality. It's currently happening, and there is already an industrial park in the UK manufacturing human organs on industrial scale today. So it's something which, when it hits you, it comes 3 years later and you say, God, I knew this, and why the hell was I buying a chemical based company? Because if you think of the old chemistry based healthcare businesses,
which is what a pharma company
which is what a pharma company is, and we are at the low end of that chain again. Like, we make the generics for the Pfizers and J&Js of the world, and we ship it. And then when they go off patent, we think in this 6 months let's luto it and sell it at the high price before the price falls. That business is gone, because now instead of dropping a nuclear bomb inside your body to kill the good bacteria, bad bacteria all together in one go, you can actually go laser target it at exactly the DNA, slice and take out. Today it may be $1,000 treatment. The way technology is going, it will be a sub $100 treatment in 3 years. It's tough days ahead to be a medical practitioner, a GP, maybe a surgeon, a diagnostic company completely disrupted, the old pharma company completely disrupted. This is happening in the next 5 years. So again, no doubt. How do you put a terminal value on these companies?
So springtime for pharma is over.
I think, you can play a dead cat bounce, like a lot of Indian pharma companies will still have cash flows. So it's not like, they roll over and die. And a lot of them will hopefully morph, like some of them have gone towards biosimilars, and they will also then go towards, gene editing and therapies and all of that. But like Roche, which was the leader in the world in cancer, paid $5 billion to buy an Israeli company because they realized they can completely disrupt the game. So there is crazy stuff happening out there in these industries, and you have to have, I think in India the issue is we are only discussing Reliance and ICICI and all. We got to get out of this frog in the well syndrome, see what is happening around in the world and how fast this is going to come and hit us. Like, if you were doing retail in India and you didn't know what Amazon and Alibaba did, you would be sitting here and say, yes, I'm enjoying life, I'm going to rule this country, right? And see what happened.
So let's get closing comments. Every time when we interact on this forum, I wish I had a 1 hour show, but unfortunately I only get 25
we can do episode 1 and 2.
We would love to do that.
Sure.
I'm sure viewers also would be delighted. But a sophisticated investor like you, someone who's seen market cycles, you have a deep understanding of the market knowledge, you can connect the dots here. But for someone who's inspired after the show, is interested in investing in this new disruptive world, how should one go about investing?
See, this is, if the average investor is doing it absolutely right in India, you buy a SIP, you invest in a fund, and if these smart fund managers cannot figure out, I don't think you as an individual should think I can beat all these guys, and you're getting it at, 100 basis points, 1% fee you're paying for this. So it doesn't get cheaper than this unless you want to do a passive fund. Passive fund, again, as a side,
it's a long debate.
is a topic. It's something going to blow up big time.
I
at
promise
some
that's
point.
the next
so
mega trend we'll discuss
we need. That's a mega trend. That this ETF and passive funds are going to blow up big time, and they will destroy the world. They'll be the next crisis coming. It's coming from here, but we'll leave that topic for now. But if you're a young guy, I always said 2 things. A, this is the best time in the world to build businesses, because money is cheap, enterprises at a premium. The financiers are dime a dozen, guys like me wanting to put money, but the entrepreneur who can go and build the business with the energy and passion is very rare. So if you're a young guy, stop thinking about only investing. Please build your own business, which is what I tell my son as well, he's doing that as well. And number 2, you cannot be frog in the well only looking and analyzing at Indian stocks. You may not have the ability to buy all these companies, but you have no business not researching them and knowing what is going on, because that's going to come and disrupt you very, very dramatically. And by the time that comes, before you can say electric car in your business is gone, it may be it's electric bike before electric car. What happens to 18 million bikes being sold in India?
I've been in this business for more than a decade now, but an honest confession from my side is that every time I interact with you on this forum, I just understand some lovely trends. So thank you for your time.
Great, thanks for having me.
And thank you for joining us on the show. Well, that's it on this edition of Market Makers. Thank you for watching the show, and thank you for tuning in.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/etnow.